Hi there, students. Welcome back to Business Management. And today we're going to be looking at different types of business entities. So this is 1.2, the second part of this Introduction to Business Unit in the IB Diploma course. So let's get started. So we've already talked about this in the previous lesson, but let's just recap. So a business is a decision-making organization involved in using inputs to produce goods and services. Businesses differ in their formal organization structures. So we realize that all businesses are different. They're structured in different ways. And so understanding these different types of business entities is quite important. For example, when we're making financial decisions for a new company, we need to know these things. And we generally talk about businesses falling into either the private sector or the public sector. So this is really important. Throughout this course, we will focus mostly on the private sector. And the public sector we will talk about in terms of it being the government sector. Okay, so let's just move on. So businesses in the private sector are owned and operated, controlled by private individuals and other businesses in some cases, operating with the goal of earning a profit. So private individuals start a business to make a profit. And in sort of the capitalist economic system, people are allowed to own resources to start a business to make profit. The public sector, on the other hand, refers to organizations in the public sector that are the businesses that are owned and controlled by the government. So typically they provide essential services and some essential goods. So they're working in order to provide the things that possibly the market wouldn't normally provide. So we've got a few examples here. In the UK, the transport system. In China, China Mobile is a public sector company. So often we're talking about things that relate to infrastructure. In some countries, communications is the public sector. In other countries, it's been privatized, and so therefore it's part of the private sector. When we talk about transport, railways, we're normally talking about the public sector, but it does depend upon the country and the situation. And the key difference here is the ownership and the control. Okay, so who it is that's owning and controlling the factors of production, the resources, the business in this case. So in the private sector, where we'll spend most of our time, there are several different types of businesses. And the simplest and the sort of normally the smallest kind of business is called a sole trader. So sole trader is a self-employed person who owns and runs the business on his or her own. They have exclusive responsibility for the success or failure of the business. The key feature is this feature of unlimited liability. Now, I want to emphasize how important this concept is and how students often get a little bit confused with the concept of limited and unlimited liability. So limited liability means that the sole trader is legally responsible for all business debts, not the business, but the actual person who owns the business. So in effect, the person and the business are one and the same thing. Okay, so sole traders face very few legal formalities to set up compared to other entities. So, of course, there are benefits of being a sole trader. In fact, with all of these different types of business entities, there's always a set of advantages and a set of disadvantages. So, a sole trader, the unlimited liability means that the owner of the business can actually lose all of their own personal assets if the business goes broke, if the business owes other organizations such as banks large amounts of money. It's the individual person themselves who will have to even go to the extent of selling their own personal assets in order to repay the outstanding debt, the outstanding liabilities. Hence, there is no limit at all to how much a sole trader can lose. They might invest $10,000, but they could lose $100,000, $200,000. So there was no limit to the amount of liability because they are in effect the business. They're tied to everything related to the business themselves. There's no separation between the owner and the business. So we've already touched on some of these things, and disadvantages. So the advantage, they receive all the profits. They are the sole person to receive the profits. Flexibility and being your own boss is a big advantage of being a sole trader. You get to make all the decisions yourself. You can provide very personalized service. You also can maintain privacy because you don't have to publish all of your sort of financial records, for example, and you can make decisions really quickly. It's just you make the decision and on you go. However, unlimited liability for debts, I emphasized that a moment ago. That's because it's so important, and that is the major reason why many sole traders decide to change their legal structure at some stage. You also have limited sources of finance because you're small. You can only take out smallish loans, and you don't have a lot of sort of collateral to back up your loans as well. There's potential for large amounts of workload and stress because even though it's good to be your own boss, sole traders do work very long hours generally. There are limited economies of scale. We'll learn more about economies of scale later on in the course, but it basically means that as you increase your output, I mentioned this also in the first video, as you increase your output, your average costs of production fall. And you can only do that when you are producing at a certain scale. Small businesses, sole traders tend to be very small. They have very limited economies of scale. There's also the lack of continuity if the owner is absent or if the business ends, meaning that, for example, the person and the business are one and the same. So, for example, if the owner dies, then the business dies with the owner. We also have partnerships, and these are businesses owned by 2 or more people, generally a maximum of 20, but I've heard of in some countries it being a maximum of 50. Partners typically pool their financial resources and share profits or losses. So it's very similar to a sole trader. It's almost like you've got 2 sole traders working together. So you have 2 people, 2 or more people. While not legally required, partners often have a formal agreement, which we call a deed of partnership. And similar to sole traders, ordinary partnerships have unlimited liability. So even though there are 2 of you and you can share the liabilities, there is still no limit to how much those liabilities could be. So again, the pros and cons, you've got greater financial strength than a sole trader because you've got 2 sets or more than 2 sets of resources to use. Specialization and division of labor among partners. So you might be really good at accounts and someone else might be really good at marketing and the creative side of business. So you can specialize and divide up the tasks. And therefore, there are also potential cost savings, potential cost effectiveness of having more than the single person running the business. However, you still have unlimited liability. There's still the potential lack of continuity, as we have with the sole trader. There's also the lack of financial privacy. You don't quite have that same privacy that you have as a sole trader. Although you're not required to publish your accounts to the public, there's still that little bit of a lack of privacy because you're sharing your accounts with another person or with other people. There is this prolonged decision making. So decision making can take a little bit longer, of course, because there are more people involved. And the potential lack of harmony there's a potential lack of harmony between partners. So in some cases, partnerships break down because of sort of things like workload or sharing of the profits, for example. Next, we have limited liability companies, and the name sort of tells us a lot here. So limited liability, obviously, we've removed the unlimited liability that is the case with sole traders and partnerships. So these are incorporated businesses with a legal difference between the owners, shareholders, and the business itself. So the owners have limited liability, meaning their personal assets are protected from business debts. Their liability is limited to the amount invested. So if they invest 10,000, they can lose that 10,000, but they can't lose more. So if, for example, the company was sued, then the company is sued and the company has to pay damages. The individual owners do not. So limited liability companies are divided into both privately held and publicly held companies. So you've probably heard of public companies. You might be aware that public companies, you can buy shares on the stock market very easily. And big companies like Apple, like Nike, like Google, for example. The ones we're talking about here, though, are privately held limited liability companies to begin with. And incorporation is the term which we use, and it ensures that the owners are protected by limited liability. So let's look at the difference between privately held and publicly held companies. So the privately held ones can't raise share capital from the general public on a stock exchange. So they can sell shares, but only to private shareholders. So normally they will sell shares to people that they know and sometimes family members. Whereas a publicly held company can sell shares to the general public through an initial public offering called an IPO, which is on the stock exchange. And they use this as a source of finance. So those companies I mentioned before, Apple, Nike, Google, they are all listed on the stock exchange, and you and I can all go and buy shares in those companies. But the privately held companies, we probably can't buy shares in those. The publicly held companies face more stringent regulations and disclosure requirements than privately held ones. But the main difference really is this ability to trade shares on the public stock exchange. We also have social enterprises, and students doing the IB diploma need to know these, especially if you're a high-level student. There is one paper 3, which really focuses more on social enterprises. So these are revenue generating businesses with social objectives at their core. They operate with a social purpose and they reinvest their profits or their surpluses back into that purpose rather than distributing them to the owners. We've got a lot of different examples: cooperatives, for-profit social enterprises owned and run by their members, who are the customers, the employees, or the producers, and they aim to create value for members in a socially responsible way. There are also non-profit social enterprises, NGOs, for example. They also operate without profit as the main goal. They reinvest their surplus for their social objective, whatever that may be. And NGOs are private sector, not for-profit entities. So we'll spend some time on social enterprises throughout this unit as well. Okay, so that's it. That's a fairly short little section, just introducing you to the different types of business entities that are in the private sector, not the public sector. So when I was talking a moment ago about public companies, I was talking about public companies in the private sector, not public sector companies, which are those that are under the control and ownership of the government. Okay. So hopefully that made some sense, and that leads us perfectly into our next section, 1.3, which we'll get onto soon. See you then.